All right, staying in South Africa, the central bank has cut its main lending rate by 25 basis points to 6.75. First meeting since adopting a lower inflation target. Now, the unanimous decision reflected improved inflation prospects. Governor Hleseta Hanyego said, with forecasts for 2025 to 2026 slightly reduced. Economists were split beforehand, unsure whether the new 3% target would limit easing. Recent positive developments like removal from the gray list, S&P upgrade, and a well-received budget review have helped support that rate cut.
Than last year. The outcome of the second quarter surprised on the upside, and the third quarter indicators are looking broadly positive. Our 2025 growth forecast has therefore been revised slightly higher to 1.3%. We continue to see growth nearing 2% over the forecast horizon. Employment has also been rising. Household spending has been relatively strong to date, supported by wealth effects, further withdrawals from two-pot pension savings, and lower inflation and interest rates. At the same time, investment has disappointed, falling further in the first half of the year. We expect an investment recovery in the second half. If this materializes, it will be an encouraging signal that the economy is getting back to its historic growth trend. As it stands, growth is better, but not yet healthy. The risks to the growth outlook are assessed as balanced. Moving to prices, inflation has accelerated somewhat over the past few months, reaching 3.6% for October. This is higher than the 3% average for the first half of the year. The uptick is due to non-core items, mainly meat, vegetables, and fuel. We continue to see this pressure as temporary, with inflation heading lower again from the beginning of next year. Indeed, recent outcomes have undershot our forecasts slightly. Because of these downside surprises, together with a stronger rand and a lower oil price assumption, we have small downward revisions to our inflation outlook for both 2025 and 2026. We remain on track to deliver 3% inflation over the medium term. For inflation expectations, we do not have an update from our usual survey at this meeting. But market rates and surveys of analysts both show further progress towards the 3% objective. Core goods prices are benefiting from exchange rate strength. Food price inflation seems to have peaked, although we have a small upward revision to this forecast, mainly from beef prices. Services inflation is unchanged from the last meeting. The announced medical aid increases are lower than last year's. At the same time, housing inflation has accelerated, which warrants ongoing scrutiny. We assess the risks to the inflation outlook as balanced. Against this backdrop, the MPC decided to reduce the policy rate by 25 basis points to 6.75% with effect from the 20th of November. The decision was unanimous. Members agreed there was scope now to make the policy stance less restrictive in the context of an improved inflation outlook. The quarterly projection model continues to forecast gradual rate cuts as inflation subsides. As before, this rate path remains a broad policy guide. Our decisions will continue to be taken on a meeting-by-meeting basis with careful attention to the outlook, data outcomes, and the balance of risks to the forecast.